Most traders have no idea why price moves the way it does. They think it's just buyers and sellers battling it out. But what if I told you there's a hidden algorithm controlling price delivery? And one of its key footprints in the market is something called a fair value gap, or FVG. In simple terms, a fair value gap is an imbalance in price. It's when the market moves so quickly in one direction that it skips over certain price levels, leaving an inefficiency. The algorithm, yes, the one that actually controls price, will eventually seek to rebalance these gaps. But knowing how and when it does that is where smart money traders gain the edge. Traders who can recognize these patterns can anticipate price movements and position themselves advantageously, turning potential risks into profitable opportunities. Here's what a fair value gap looks like. Notice how price shoots up aggressively, leaving this space where no trading occurred. This tells us that institutions push price rapidly, creating an imbalance that the market may later come back to fill. Not all fair value gaps are the same. Where they form in price structure is critical. Let's break it down. The premium level, which is the high of the fair value gap, acts as support in a bullish market if price closes above it. The discount level, identified as the low of the fair value gap, serves as resistance in a bearish market if price closes below it. The consequent encroachment, positioned at the 50% midpoint of the fair value gap, acts as a crucial reaction zone where price may either reject or fully rebalance. This is where smart traders differentiate themselves. Instead of blindly entering trades, they wait for price to react to these levels, using them to confirm trade setups. When a fair value gap forms aggressively, it's a sign that the algorithm is in a hurry to move price. ICT calls this displacement. Think of it like an elephant stepping into a small pool. The water doesn't just ripple, it gets thrown everywhere. That's exactly what happens when large institutions enter the market with massive orders. This kind of move tells us that smart money is active. If we understand how they operate, we can position ourselves on the right side of the trade. As the algorithms work, they create patterns that can reveal the intentions of these large players, giving savvy traders a chance to anticipate market movements. By recognizing these patterns, traders can align themselves with the flow of the market, riding the wave instead of being swept away by it. Understanding displacement is not just about observing. It's about taking action and making informed decisions that can lead to profitable trades. With each trade driven by knowledge of algorithmic behavior, traders can find themselves not just surviving but thriving in the fast-paced financial landscape. This mastery of market movements transforms the experience from mere speculation into a calculated strategy, leading to consistent success in trading. So how do we use FVGs in real trading? Here's a simple but powerful strategy. 1. Identify a strong displacement move with a clear FVG. 2. Wait for price to retrace into the FVG, preferably to the CE 50% level. 3. Look for confirmation. This could be a rejection wick, a liquidity sweep, or a market structure shift. 4. Enter the trade in alignment with the overall market bias. This is how the big players operate. They don't chase price, they let it come to them. And now you can do the same. By understanding and applying these principles, you are on your way to mastering the art of trading fair value gaps like a pro. Fair value gaps are not just some random anomaly in the market. They are an algorithmic footprint, a sign of institutional involvement, and a roadmap to where price is likely to go next. If you master FVGs, you gain an unfair advantage over 95% of retail traders. If you found this valuable, make sure to like, subscribe, and drop a comment below. Let me know, do you use fair value gaps in your trading? Thanks for watching, and I'll see you in the next one.